Hey everyone, Texas Instruments reported second quarter earnings. In this video, I'm going to review their latest financial results. I'm also going to update my recommendation of Texas Instruments stock. Heading into these results, I had the stock rated as a buy, so you're going to want to tune in to see if I'm upgrading, downgrading, or keeping the stock recommendation the same. So let's get right into it. Starting with revenue. 4.53 billion for the second quarter for Texas Instruments. That was down 13% from the same quarter last year. Earnings per share, likewise, of $1.87 was down 24% year over year. Remember, this company makes chips for markets such as industrials, automotive, personal electronics, computing, and enterprise systems. Of all of those, really, automotive is the only segment that's seeing rising demand at the moment. Enterprise systems, remember, companies are fearful that a recession is oncoming, and so they've gotten more cautious in terms of their spending, especially on IT. These are things that companies like to spend more on when they're not expecting decreasing economic activity. Similarly, personal electronics. Remember, people bought a lot of electronics in 2020 and in 2021 when away from home activities were limited, you can say. Restaurants were closed, theme parks were closed, sports teams were not allowing fans in attendance, so we had fewer things we could spend on, and people were buying more electronics. Why is that bad for Texas Instruments right now? Well, because if you buy some of these things, they are long lasting. They last you for several years. So if you bought an iPhone or if you bought a big screen TV in 2021, you're probably not going to buy another one for several years. And so many consumer electronics, like the ones I just mentioned earlier, people bought during 2020 and 2021, and now people aren't buying them anymore as much as they were in those years. So there's a gap for consumer demand, and that's hurting Texas Instruments right now. The good news is, I think this is a short term phenomena as people need to update those devices in the coming years. That's going to create an increase in consumer demand for Texas Instruments, although it's not going to be in 2023. The rest of this year is likely to be like the start of this year for Texas Instruments. But starting 2024, maybe the second half of 2024, you could see demand start to increase for Texas Instruments as those renewals start to come in for those electronics people bought in 2020. So that's really the story here for Texas Instruments. It's not going to look good for the rest of this year. Although, to update my recommendation for the stock is not considerably expensive. So despite these difficulties in the short term, I'm keeping Texas Instruments stock rated as a buy because over the longer term, I expect demand for its chips to continue to be robust as we buy more and more electronics, as the digitization of goods continues as a strong tailwind. So there you have it. I'm keeping Texas Instruments stock rated as a buy, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.